Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary. Welcome back to another week. So I apologize, last week we had a little bit of technical difficulties. I did record a video, and when I went to upload it, realized that there was no audio. And so I figured you probably did not want to watch a video of charts without actually hearing what I had to say. I'll give you the recap real quick though. So last week I was preparing to let you know that relative strength had been improving and that momentum had been improving and that we were preparing to probably take new positions. And about 10 minutes before I started to record my video, President Trump tweeted out that he was suspending all talks of stimulus until after the election. The Dow Jones subsequently did a 600-point reversion where it was up and closed fairly negative for the day. And so I real quick had to come up with different talking points because relative strength and momentum changed in a matter of about 20 minutes that day. So I real quick got another video together where we talked about things that were happening and affecting the market. But then at 10 o'clock that night, after that video had been recorded, President Trump retracted what he said and said that he was in favor of stimulus prior to the election. Markets then rallied and responded accordingly. Now, today and yesterday, markets have been struggling, certainly weaker with negative performance, looks like for today as well. We are going to close fairly sharply negative compared to where we were. And this is really all coming back to the fact that now investors are beginning to doubt that we are going to get stimulus before the election. It looks like we're still kind of in that stalemate that we've been. And the point here, the reason why I told you kind of what happened last week is there is a lot of noise in the market right now. There is a lot of outside pressures that are really causing havoc when you look at the daily price movements. And this is really why it is so important to really have a program and a process that you're following so that you're not having to read the news and read the highlights to kind of figure out what your next plan should be. The idea is that you should have something that's able to kind of decipher through the noise and really show you what's going on. So the market is still incredibly dependent right now, it seems, on stimulus. It seems like the market is asking for more and more just to kind of tread water. I think that certainly, at least for the intermediate term, is concerning when we realize that as soon as the investors realize that maybe that stimulus is actually not coming, the market responds very negatively, very quickly. So that being said, what do you do as an investor? What do you do as a financial advisor in a market like this? And so those are some of the things that I want to get into today. And so first of all, remember the month of September, we were basically in, for the entire month, we were in quite a corrective type of process. So this is the S&P 500. Here is our 50-day moving average. Remember, moving averages act like magnets that we really typically for the long term will trade closely above or closely below. And so we were fairly extended here, came back below here, consolidated here. We really kind of bounced around that average for a while. And then finally, last week, and a little bit the week prior, we began to kind of break out above, and then this has been from the stimulus run that we've had, kind of see where we were for the past few days. This is actually, though, as of Monday. This is an interesting chart. This is an interesting breakdown. So this is really just from September through today. What I really wanted to show you here, so here we were, this was back towards the beginning of September. Then this is just kind of showing as we were trading below that 50-day average. And then we really just consolidated for a long time here. And one of the things you might remember me saying is that we were waiting for relative strength to shift positive so that we could take additional positions. And this is really interesting. I want to show you this because this is kind of how it works. And so relative strength had dipped quite a bit below 50. We were kind of waiting for it to close above 50. And so here we finally kind of got that confirmation. Here we began to take positions here. And then so you can kind of see then the market's kind of been on an upward trend since then. So again, waiting for relative strength to kind of break above those points can be extremely beneficial to kind of weed out some of that noise that we see with market volatility, especially with the type of year that we've had this year. This is a year that advisors and investors alike are going to look back and say, you know, that's something that we've never seen before and likely we'll never see again. So it's our job right now to make sure that we have a process that's driving our decision making, especially when it comes to deciding how we're going to be invested for our clients. And so we did last week take additional positions. So we did add to our large cap growth position, we added another 5%, so we're at 10% in large cap growth. We also added another 5% in both small and mid cap growth, and so we got some confirmation again from the technicals when we looked at momentum and relative strength that we should be adding positions there, which brings us up to we're now 40% equity, 50% in fixed income, and just 10% in cash. So what I wanted to take the next couple of minutes to show you is really though, so this is the power of relative strength and momentum. I took a couple of the positions that we have right now, currently in our models, and just kind of showing. So PKB, this is going to be an industrial asset class that we are invested in. So for 1 month return, so from September 14th through October 14th, that fund is up 12.15%. And then you compare it to some of the other ETFs in its peer group, the next closest up one is up 6%. So again, areas of positive momentum, positive relative strength, and you know that you're in the right area. This is another fund. So this is going to be our online retail consumer fund. Up for the month, we are up 16.42%. And then compared to other funds, up 14, 13, 5.7, 4.2. Again, we want to be in the right areas. And that's the idea, that if we can have confirmation that the areas of exposure that we have are right, we can add to them gradually and prudently. And over time, we will absolutely have success with outperforming the index. QQEW, this is our large cap growth fund. So this I think is fascinating. So it's up for the month 9.68% compared to the S&P 500, which would be the index that it follows, at 5.26, almost doubling the S&P 500 returns. Again, it's not just being in the right asset class, but actually being in the right ETF or fund that has that best relative strength and momentum that's going to give us our long-term success. And then our innovative technology fund up 19.6% for, 18.78% for the month. And then you can just kind of see other areas were up 18, 12.9, 4.2, again, in the right area. So we still have fairly small bites of the apple right now. Why? Well, you may not have heard, but there's an election coming up in a couple of weeks. Very possible that we'll see some volatility moving into that. So we want to make sure we're in the right areas, and then we will kind of continue to chip away. And then once we have that final all clear, really be able to start making up some ground. We just want to make sure that we're doing it prudently. And so currently, these are just the areas of equities that we have exposure to right now. So consumer cyclicals, consumer discretionary, innovative technology, large, mid, small cap growth, and industrials. And so the idea is that we just need to make sure that we have the right exposures, and at the same time, what's equally as important is that we avoid the laggards. So we want to avoid those areas of weakness, which is just going to pull down our performance potential. And so that's the way that the program that we use works. And we don't always have all the answers. And so I say we have to make decisions based upon the information that we have right now. What happened yesterday doesn't necessarily, help us today. And so we really just stick by the principle that we want to earn performance, and at the same time, we want to preserve principle. And when our program shifts that principle preservation needs to be number one, we're okay with that. We are okay to be defensive in the short run, knowing that having the exposure to the right areas, we'll be able to make that up. We just want to make sure that we don't get caught by surprise with other areas of market volatility. And so that's really what I wanted to share with you today. We're really excited just about the positions that we're taking, how the models are performing, and we feel great about the long run, what this is going to mean, and we just need to make sure that we continue to follow our process. So as always, if you have questions, I would love for you to reach out to me either by email, or you can always give me a call. On our website, you'll have access to all the newsletters that I write. So I write a minimum of one newsletter a month, sometimes more often. So you can go back to our website and check some of those out. And again, as an investor right now, I would just say that this is the time to be paying attention to risk in your portfolio. I would say that you don't need to be completely out of the market, but it is a time for you to know where you're exposed, how much of exposure that you have, and do you have areas of hedging and defensive measures in place that you can kind of pull at any time. And because that's really where we're at now, is that we're really paying attention. So we're trying to find some performance, because obviously that's important. Our clients expect performance, but at the same time, understanding that where we are right now within the market is still somewhat precarious. And so we're listening and we're watching, and I say that we're cautiously optimistic. I also think it's fair to expect that we will continue to see volatility, certainly moving up to the election, even beyond the election, depending upon kind of what the outcome is and just what actually happens with the election itself. So I think that, on our end, we're expecting there to be volatility. We're expecting that the market will probably get a little sloppy from here, probably till the end of November. And then again, as the technicals kind of guide us, then we'll be able to act accordingly. So again, this is Ashley Rosser with Victory Fiduciary. I hope you have a great week, and we will see you next week.